multifamily DSCR for 2 to 4 units. Hey, what's going on, everybody? Jeff Trevarthen, Jeff the Mortgage Pro. Today we're going to talk about DSCR loans and buying or refinancing multi-unit property, specifically 2 to 4 unit multi-unit property. So duplexes, triplexes, and fourplexes. Before I get into it, do me a huge favor. Go ahead and click on that like button if you like these videos, and feel free to share them with friends and family if it's something that you find interesting and they might find interesting as well. And then if you really like these videos, please go ahead and hit that subscribe button down below. That helps get my message out to as many people as possible, and I really do appreciate you watching this and sharing it with other people. All right, let's talk about multifamily DSCR loans right now. So first of all, a DSCR loan, this is a loan that is based on the cash flow of the property, not your own personal income like conventional loans are. So whether you have a job or not, you can still get a DSCR loan as long as you meet the basic requirements to get these types of loans. So let's go through some of the parameters here to see if it makes sense for you. So with DSCR loans, we can do loans all the way up to $2.5 million. Okay, we might even be able to go a little bit higher than that based on exception. I haven't seen one that big yet, but just in case, if you do have a big project and it's a multi-unit property, 2 to 4 units, maybe it's $3 million, we can definitely help you out on something like that. This is for investment properties only, and that means that you cannot live in any of the units. So specifically duplexes, triplexes, and fourplexes, you cannot live in any of the units with a DSCR loan. If you do, it's considered occupancy fraud, and you probably don't want to get caught with something like that. So these are for investment properties only. There is no personal income required to get a DSCR loan. So no tax returns, no pay stubs, no W-2s, nothing like that. So if you're self-employed or you don't have a job, don't worry, you can still get a DSCR loan as long as you meet all the other minimum parameters when you're trying to get this. There's no limit to the number of properties that you can own with a DSCR loan. So you can own 5 or 2 or 50, it doesn't matter. So that's pretty cool about that. And there's no limit to the number of properties that you have financed. And if you were to do conventional loans or jumbo loans, oftentimes you're going to run into restrictions on the number of properties that you have financed. So with DSCR loans, that doesn't matter. The different options for DSCR loans, there's 30-year fixed. There's some ARM products, but I don't think the pricing is really any better than that of the 30-year fixed mortgage. So I typically just recommend somebody go with a 30-year fixed type of an option. There's 40-year fixed options, and then there's even interest-only options if you really want to try to get technical with cash flow. So what I like to do is qualify people with each of those different options. Let's do a 30-year fixed, a 40-year fixed, 30-year interest only, and a 40-year interest only, and let's see which one has the lowest payment. Because it doesn't really matter what the lowest rate is when you're doing investment properties, because the whole thing is based on cash flow. So let's figure out what the lowest payment is, not necessarily what the lowest rate is, if that makes any sense. Okay. You can have as little as 3 months worth of reserves when you're using the DSCR loan. So if 1 month of reserves is a principal, interest, taxes, and insurance monthly payment, and if you were to multiply that by 3, that's 3 months worth of reserves. So for example, if the PITI is $1,000 and 3 months of reserves is going to be $3,000. So that can be in stocks or bonds or 401ks or IRAs or savings accounts or checking accounts or money market accounts. Anything that's somewhat liquid can typically be used as reserves for these DSCR loans. You can do as little as 15% down, but probably the minimum is going to be 20% down. And then if you can get to 25% down, all the better. The pricing is going to be the most optimal at 25% down. The reason why I say 15% down is kind of tough is that most mortgages, if they have less than 20% down, they have mortgage insurance on them. But with DSCR loans, you don't. So what ends up happening with that quote unquote mortgage insurance? Well, it's built into the rate. So rates are going to be a lot higher. And when you put 15% down, it's going to make the property harder to cash flow. So it makes it just a little bit trickier to qualify. But as little as 15% down in some instances, if you got a really good cash flowing property, then maybe that's an option for you if that's all the cash that you have. But if you can get to 20% down, you're probably going to be pretty good with the DSCR loan. We can do credit scores down to 640, maybe even 620. 640 is probably about the minimum that I like to work on, just because it's still available for a lot of lenders. You can still do that. Once you get down to 620, there's very few lenders that will allow you to do a DSCR loan, but it is available. And the terms are not going to be as ideal when you have a lower credit score like that. So the better your credit score, usually the better terms. So make sure that, just like any other mortgage loan, credit is important. So keep your credit up if you're going to be borrowing money for these DSCR loans as well. With cash out refis, there's different seasoning periods, and seasoning means the amount of time that has to elapse after you purchase a property before you can do a cash out refinance. So most lenders will make you wait 6 months, even a year before you can do cash out refinances. I actually have a lender, or two actually, that will allow no seasoning on cash out. That means that you could purchase a property, do a little bit of a renovation on it, and then a month later, if you or however fast it takes you to get that property up to the new market value, you can do no seasoning on cash out. You can do a cash out refinance based on the new appraised value of the property. So this is a cool one. I love using this product. So if that's something that interests you, please reach out to me for that one. Non-warrantable condos. These are allowed. So residential real estate, when you're buying condos, a lot of times there's issues with the HOA. That means that it has litigation on it or something of that nature that makes it not eligible to be financed by Fannie Mae and Freddie Mac or even some of the jumbo investors. And if that's the case, then you're not going to be able to get a normal loan on those types of properties. Well, DSCR loan, they don't care. So as long as you're putting 25% down, somewhere in that range to get those properties, you can buy non-warrantable condos with the DSCR loan. The market rent is usually calculated through the rental survey, and that's usually used to determine the DSCR. So say you're buying a property that is not currently a rental property right now in that 2 to 4 units, and you buy that property and maybe it's two families that own it, and they're both living on each of the different sides of the duplex, but we would need to determine what the rental income is. And in that case, what we do is we do a rental survey during the appraisal process, and that rental survey will take the comparable rents of similar size units in that area and figure out what the rental income is. And that's the number that we have to use for the DSCR loan. But that doesn't mean that you can't rent it out for more. So if the market lets you, always rent it for as much as you possibly can using that property. Okay. And then short-term rentals are allowed with these. So if you have let's say you have a fourplex that you're looking at and it's next to the beach, you can actually, rent each one of those out as an Airbnb. So that there's a big potential cash flow for these with short-term rentals. And that's anywhere from 2 to 4 units, again, is what we're talking about. So these can definitely go into play and definitely help you out. And then lastly, remember that DSCR loans are typically going to come with prepayment penalties. And that means that if you were to pay it off early, you get penalized for doing that. Now, weigh your options, figure out how much the loan amount is. If you're paying off a $100,000 loan early and it's a $1,000 penalty, in the grand scheme of things, that's not a lot of money, especially when you're borrowing hundreds of thousands of dollars for that. But if you're doing $1 million loan and it's a 3% penalty, that's $30,000. That could be really expensive. So kind of weigh your options, but just know that DSCR loans have prepayment penalties anywhere from no prepay all the way up to a 5-year prepay. The longer the prepayment penalty period, the better the interest rate's going to be, just in general. Okay. So if you have any questions and you want to buy or refinance your multifamily property that's 2 to 4 units, I would love to be the one that helps you out. This is my niche and this is what I do. If you have any questions at all, or if you'd like to chat about that, please go ahead and click on my calendar link down below and let's chat for a few minutes and learn more about what you're looking to do and see if I can help. Thanks so much for watching, and I will see you on the next show. Have a great day. Bye.